Hello everyone, welcome to Manu's Classroom. In today's video, we are going to try and understand what an accounting cycle is. So this entire video, in fact the entire Accounting for Managers series, I have crafted in such a way that people from non-commerce background can easily understand the concepts of accounting. Alright, so let's get started. So let us recap quickly what accounting is defined as. Okay, so according to AICPA, we define accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. Okay, so in short, accounting is recording, classifying, and summarizing in terms of money. Okay, recording in terms of money, classifying in terms of money, and summarizing in terms of money. Only those transactions or events which happen in any environment, okay, either be business or in the lives of an individual, doesn't matter. Those transactions are events which involve money in it, that is having economic significance. Okay, so and there are four phases of accounting, that is just like in the definition itself, that is recording, classifying, summarizing, and interpreting. Okay, so recording is we write down those financial transactions. Classifying is we group those financial transactions. Summarizing is we uh, create reports. Okay, it could be your balance sheet, it could be a profit and loss account, sorry, profit and loss statement, whatever that is. Okay, that is summarizing. That is transforming these recorded financial data into usable financial reports. That is summarizing. And then interpreting is done on these reports. Okay, so whatever inputs we got in the form of financial transactions, we had classified it, we had recorded it, classified it, summarized it. Okay, and now after we create either say the balance sheet or maybe a profit and loss account, whatever that is. Okay, after we prepare it, we give it to either the manager or the stakeholders, maybe the auditors, or maybe people who are interested in investing in our company, whatever that is, we show it to them, and then they'll read it and interpret it. The reason why in MBA we have this subject, okay, accounting for managers, is because we will be doing a lot of interpreting. Okay, so the main aim is not for us to be able to record it or classify it or summarize it. For that we have the accounts department, we have people who have done their BComs, MComs, even CAs, right, CA, CMA, whatever that is. Okay, all those different things, we have people over there. We have the accounting department, we have the finance department, they'll do it. But as managers, we should know to interpret those. Now in order to know to interpret these things, we should at least know some basics about how we should record, what are the things we can record, what are the things we can adjust, what are the different ways in which we can record all these or classify all this or summarize all this, we should know, right? So that we can find out, even if the accounting department, whoever that is, if they made a mistake or if they did not do it properly, or whatever it is, or whatever they have written, we should know how to read it, right? We need that accounting literacy as MBA graduates. So that is the reason why we are learning this first and foremost. Okay, so that is the definition of accounting. It is very important. That is why in multiple videos you will see me recapping these concepts, because these are the fundamentals. Okay, so before going to understanding the accounting cycle, let us try to understand what these three concepts mean. Okay, bookkeeping, accounting, and accountancy. Okay, so these are the three, again, these are three words which come very frequently in accounting. Okay, so what is bookkeeping? Bookkeeping is the process of recording the company's financial transactions into organized accounts on a daily basis. Okay, so there are different recording techniques which a business can use also, but bookkeeping is essentially a part of your accounting process. So as we said, right, the four phases of accounting, it starts with recording of our financial transactions. So these financial transactions, they will be recorded in books, right? And that process is called bookkeeping. So the first recording of these transactions would mostly happen in your journal, from which it will be posted to your ledger, and then from then thereon into multiple other books, right? So the process of keeping these books up to date, right, that entire process is called bookkeeping. Okay, so we have written the journal, we have posted it into the ledger and multiple other books of accounts. Okay, that is bookkeeping. After that is done, accounting starts. Okay, So that is why we say accounting begins where bookkeeping ends. And accounting therefore is a much wider concept, okay, and it includes the summarizing, interpreting and communicating of the financial data to users of the financial statements, okay. So that is accounting. So the you can see that we in the course of this MMPC 4, that is accounting for managers, IGNOU actually has us study a lot of different types of accounting, right, and bookkeeping, like journaling, ledgering, and then we learn how to prepare a trial balance, a balance sheet, a profit and loss account, okay, cash flow statements, and a lot of other things, okay. We'll be learning all those things one by one, okay. So um yeah, so this balance sheet or this profit and loss accounts, all those things are a way of actually summarizing, okay, these transactions which we had recorded in our journals or ledgers, okay, and that is actually accounting, you can say. And once we create the balance sheet, once we create the profit and loss account, we will also learn how we can interpret those, okay, what each of those figures would mean. And then that is how we can communicate financial data to the users of those financial statements. Maybe we can prepare presentations, maybe we can give those reports as is, okay. So that is accounting. And this entire process of this knowing the systematic knowledge of accounting principles and techniques, like what are the different ways in which we can record these financial transactions, or in different ways in which we can adjust these money, or adjust these transactions over a period of time, all those, there are a lot of techniques, okay, which are generally accepted globally by the accounting people, okay, the people who are in the, what you can say, in the career path or in the profession of accounting. And that entire systematic body of knowledge, that is called accountancy. So I hope this is clear to you. In case you have any doubts, okay, throughout the video, in case you get any doubts, please feel free to comment your doubts below the video. I'll get back to you. Either if it is required, I'll create a new video to clear your doubt, or I would give clear your doubts in the comments itself, okay. So let us move on to the actual topic for today's video, that is the steps in accounting cycle. So basically, in the accounting cycle, what we call the accounting cycle is a 8-step process. Now if you go to the net and you try to Google accounting process or the accounting cycle, you will find um, like 5-step processes, 8-step process, even 9-step process, okay. It varies a little bit here and there, but generally we can what you can say, with yeah without condensing a lot many topics or lot many processes into one, or unnecessarily dividing processes into multiple steps, we can almost decently summarize this accounting process in 8 steps, okay. And that 8-step process is what we will be learning as the accounting cycle in this video, okay. So this accounting cycle is an 8-step process for completing a company's bookkeeping task, okay, and it provides actually a very clear guide for this recording and analysis and final reporting of the business's financial activities, okay. It is made, or it is designed to make the financial accounting easier for business owners. And what you can say, finally, like at the end of every financial year, we start our books of accounts, okay, and at the end of that financial year we close it. So the starting comes with recording of transactions, the very first transactions that come in, and at the end of that accounting cycle, or at the end of that accounting period, generally we treat it as March 31st, right, April 1st onwards a new accounting cycle begins. That is how we think of it, right. So on March 31st, we will close all the books of accounts, and what will happen is that on that day we will prepare the financial final reports, and it will give us a good picture, overall picture of how our business performed throughout that financial year, okay. And that is used by many people to analyze the business. And almost all this accounting is done electronically right now. Earlier we used to have manual, we used to keep these books of accounts manually, but right now we have a lot of other lot of softwares available for free and paid, proprietary softwares, or then you can even make IT companies prepare customized softwares for you. But whatever it is, right now most of it is happening electronically. So this is the 8 steps of our accounting cycle. First and foremost, it starts with identifying the transactions. Then we will record those transactions in the journal, okay, and then we post those transactions into the ledger. And then once after this, what happens is that 1 2 3, these 3 steps, right, identifying transactions, recording those transactions, and posting them into a ledger. These happen almost on a day-to-day basis. But at the end of the so every day we don't generally we don't create the trial balance most of the cases, right? It is at almost nearing the end of the accounting cycle only we create the trial balance, and then we analyze the worksheets, and then we adjust the journal entries if required, okay, and then finally create the financial statements, that is balance sheet, profit and loss accounts, profit and loss statements, all those things. And then at the end of the accounting cycle, that is the accounting period I should say, we close all our books of accounts and we start them as a fresh book from the next accounting cycle or the next accounting period onwards, okay. So the reason why this accounting cycle and accounting period comes interchangeably is because of the same reason only, that is accounting period, at the end of the accounting period only we close the book of accounts, which is again denoted as the end of the accounting cycle as well, okay. So that's why you will find that these two terms, accounting cycle and accounting period, they get used interchangeably, but don't get confused, it all follows the same cycle, okay, the same process only. So these are the 8 steps in the accounting cycle. Now let us look at these 8 steps a little bit more closer, okay. So the first step was to identify these transactions, right? So companies will have many transactions throughout the accounting cycle, all right. It could be sale of goods, or it could be purchase of some machinery, maybe they have paid for some service of something, or maybe auditing of something, there was a maintenance maybe, so a lot, or maybe they decided to hire a few people, whatever that is, there will be a lot of transactions happening in a company throughout this accounting cycle. And accounting cycle, again let me repeat, accounting cycle and accounting period is used interchangeably, okay. So each one of these transactions need to be properly recorded in our company's books, whether it be ledger or journal, whatever it is, it starts from journal, okay. And only those transactions or events which are of financial nature, okay, that is it involves the flow of money, either money comes in or money goes out, doesn't matter, but only those transactions and events which have a financial nature to it, those transactions only we need to identify from this complete pool of all this business transactions happening, and only those needs to be recorded. So that is why we say we need to identify these business transactions, okay. And naturally all these transactions and events are measured in terms of money, which is considered as the common unit in accounting, okay. So that is identification of these transactions. Next step is we record these transactions in a journal, okay. Yeah, so we will learn how to post entries into a journal quite soon. So till then, let us understand that journal is a book. Right now journal is a electronically maintained book, but whatever that is, let us assume that it is a book which holds which what you can say, which has some columns. First is the date. The date will have that date on which the particular transaction which we are going to write down had occurred, okay. So that is the date. Then we have the transaction description or the detail, that is a one liner about what the transaction was, and then it will also have from which account, or like, yeah, from which account the money got debited, and then to which account the money got credited, okay. And naturally there will be two columns, one for debit, the other for credit. So the debit part of it will write which how much amount of money got debited from the debiting account, and the credit would be the corresponding amount which got credited into the crediting account. So these two amounts, okay, the debit and credit would always be same, because right now we are following a double entry book system, okay. So that is an overview of the journal. Don't worry, just understand that we will be recording it into a journal. We will come to know what a journal is and how to write all those things, all these entries later, okay. So the third step is posting. So once we write this journal entry, then we have another book called a ledger. In this ledger, it is kind of similar to journal only, but what happens in a journal is whatever transactions are coming, right, on a day-to-day basis, whatever is hitting the organization, it will be written like in a chronological manner. First transaction, then the second transaction, doesn't matter, okay. But in a journal we will classify these transactions, or you can say group them, okay, on the basis of accounts, okay. So we'll have a cash account, maybe we'll have a sales account, we'll have a purchases account. These are different accounts which denote different things, okay. A capital account denotes all the capital that is there in the account, in the business. Sales account will denote all the amount of money we generated or we lost through sales. Purchases account, again naturally it will have all the money which we spent through purchasing, okay. So similarly we have different accounts. So in ledger what we will do is all the transactions belonging to a particular account, say sales account. Okay, so no matter whether the sale happened on the 1st of January or the 30th of January or maybe the 30th of 15th of February, doesn't matter. All those transactions will be written down together in the place where we write down all the sales transactions or the purchase transactions, whatever it is. So it is kind of like a grouping, and that is what happens in your ledger. Okay, so that is called posting. So after that, the step 4 is adjusting of the trial balance. So as we said, right, at the end of the accounting period, we create a trial balance. Okay, and the trial balance will tell the company about its unadjusted balances in each account. Okay, and this unadjusted balance we carry forward to our next step, that is for testing and analysis. Okay, so like for example, if we generated a lot of sales, then naturally our sales account will have a much higher amount of money than the our expenses account, right? So there is a mismatch there. Now we have to balance it. So how we will balance it, how these things have to be adjusted, all those things we will find out after preparation of this trial balance. Okay, so this is one of the first steps that take place once the accounting period has ended, and all the transactions that happened within that accounting period has been identified, recorded, and posted to the ledger. Okay, and this is done to make sure that the total credit balance and the total debit balance are equal. It should be equal. Okay, and this stage we can actually catch a lot of mistakes in those if those numbers do not match up. So maybe sometimes we might have forgotten to post the crediting, what you can say, the crediting accounts balances properly in the ledger. Some human errors could happen, right? Some errors could happen. So when we prepare the trial balance, we will be able to find out all these mismatches. Okay, the fifth step is preparation of a worksheet or analyzing of this worksheet and identifying and adjusting the entries that has led to a difference in the trial balance. Okay, so this worksheet is created, which will be used to ensure that debits and credits are equal. So supposing, say, we found some mismatch when we were preparing the trial balance, we will prepare a worksheet and we will see how we will see these transactions and try to find out how we can adjust or we can correct these debits and credits mismatch. Okay, so in addition to identifying any errors, the adjusting entries may be needed for revenue and expense matching also when we are using accrual accounting. Okay, so accrual accounting is a little bit different type of accounting from the normal accounting which we say. Okay, not to worry, it is not needed for us as in MMPCs for to know more about accrual accounting. But if you are interested, let me know in the comments. I'll make a video on what accrual accounting is and how it is different. Okay. Then the sixth step is adjusting the journal entries. So we prepared the trial balance. We might have found out that there are some errors. So we created a worksheet. We found out how we can adjust or how we can fix the problems in the trial balance through that worksheet. Okay, now depending upon that identification, we'll go back and adjust the journal entries. Okay, so that is the sixth step. The bookkeeper will make adjustments, and these adjustments are recorded as journal entries wherever it is necessary. And then seventh step, we prepare the financial statements. So after the company makes all the adjustments and everything, it generates the financial statements in the seventh step. Okay, so usually they include the income statement, the balance sheet, cash flow, profit and loss, all these things. Okay, so that is the financial statements which will be interpreted by us managers, correct? And then once these financial statements we have created it, we will close these books. Okay, so there are actually two types of accounts. Okay, one is the actual real account, you can say, and the other is temporary accounts. So whatever is the temporary account, right, like for example these miscellaneous expenses or these drawings accounts and all, they are temporary. Drawing account comes into picture when somebody who was invested in the company, if they try to withdraw money from the company, for their personal use, okay, not for the use of the company but their personal use, then it is called a drawings account. Okay, that will be posted into a drawings account. And at the end of the accounting year, what we do is that drawings account, whatever is the balance, okay, after the debits and credits, okay, whatever the difference is, we will post it into the capital account as that particular person's liability has either reduced this much or increased this much, like that. Okay, so that will be eliminated, and whatever that net difference is, we will post it to the original account, that is the capital account. Okay, and that capital account's money, whatever is balance in that capital account at the end of this accounting cycle, we will start with that balance only in the next year. Like for example, you are a business owner, you started a business, and let's say you invested 1,000 rupees. Okay, I know it is a very small amount, but let's assume. Okay, now in the middle of the accounting year, okay, sometime in July or August, you took 500 rupees from the business for your personal use and you did not give it back. Okay, so at this 500 rupees, right, it will be first posted into your, during the accounting cycle, it will be posted to your drawings account. Okay, but at the end of the accounting year, when you're closing the books, what will happen is this 500 rupees, since you took it out, right? Now, earlier, before you took out this 500 rupees, actually, 1,000 rupees was in your capital account, right? Now, after you took, it is only 500. So, before you took this, company was liable to pay you 1,000 rupees. But since you already took 500 from it, now the company will only be liable to pay you 1,000 minus 500, that is 500, right? So, when the new accounting cycle begins, provided that you did not give back this 500 rupees, okay, you did not give it back, then what will happen is this drawings account, it will be actually, you can say, you can even think of it as like merging it with the capital account, right? So, when the new accounting cycle starts, the capital account will only have 500 rupees. Okay, so it will not have 1,000 rupees, but it will have 500 rupees. But drawings account, it will have zero. Why? Because this 500, it got posted back into your capital account. So this is how it happens. Okay, don't worry if this closing feels a little bit confusing. We have videos coming up, right? I'll try my best to make it a bit more clear, okay, in case you did not understand. But of course, if you have doubts, let me know in the comments. Okay, so that is closing of the books. Okay, so after closing, this accounting cycle will start over again from the beginning. That is identification of the transaction. From there, step 1 onwards, it will start again. Okay, so that is the 8 steps of accounting cycle. So thank you for sticking with me till the end of this video, and I really hope that this video helped you to understand the concept of accounting cycle much better. Okay, so if you did like the video, do leave a thumbs up. If you have any doubts, post it in the comments. And if you like how these videos are created, consider subscribing, consider recommending us to your friends also. I'll leave a link to the playlist for MMPC 4, that is Accounting for Managers series. We are doing videos topic wise, so whichever topic you feel you need clarity on, feel free to go ahead and check out that video. Okay, so we are making it independent videos, and anybody who is interested in learning accounting can look at these videos to have a basic understanding or a basic literacy on this matter. It doesn't matter whether you have come from a science background or whether you are just going to start your commerce stream in your 11th or 12th. It will be helpful to anyone and everyone. Okay, I've created it in such a way. So thank you so much, and all the best for your future endeavors. Bye bye.